Hi, folks. Keir Reynolds here, host of Talk Stocks. Welcome to something a little different. We're trying out a new format today, more of a personal deep dive. This is actually part of my own process when I'm evaluating investments. I'm excited to share it with you. Our first company on deck is McCoy Global, ticker MCB on the TSX. We'll break down how this 110-year-old company is transforming well construction with automation and data-driven solutions. Let's get to it. I'd be remiss if I didn't mention our disclaimer slide. This, of course, is not investment advice. I'm not a financial advisor, and I share this with you as part of my own personal investing journey. Please consult with a licensed financial advisor before making any trades, and please make sure to conduct your own due diligence. And of course, this presentation likely contains some errors, so make sure you look things up for yourself. All right, company overview. Who's McCoy Global? Well, they're based out of Edmonton, Alberta. They might sound on the surface like just another player in the oil and gas field, but wait, the company's actually been innovating since our great grandparents were reading about oil booms in the newspaper. With a presence in over 50 countries now and offices from Canada to the United States to the UAE, McCoy isn't just local; it's really gone global. They specialize in wellbore integrity and data acquisition systems and automation. So they even have an AI component that the company's in process of sort of building. I guess if I were to sum it up, what's the company really do? Well, it makes sure that that oil and gas wells, whether they be land or offshore, are well constructed. They're playing an industry where safety and efficiency are everything. And McCoy's 110-year legacy is really proof that they know a thing or two about keeping things running smoothly. All right, slide 4, growth opportunities. Let's talk growth, because who doesn't love that word in the stock world? McCoy is all about leveraging the latest tech to automate well construction, which means fewer errors, faster processes, and yes, more profits. Uh, as some of their automation, they're also able to reduce the number of people that might be needed to actually, from a services side, drilling side. But they're also not afraid to pack their bags and explore new regions to grow their operations. Geographic expansion is really their middle name. Well, not really, but I think you get the idea. And if you think they're resting on their laurels with the same old tech, think again. McCoy is rolling out cutting edge products to meet the industry's ever changing needs. Now, if you're wondering why this tech company is valued like an oil and gas services firm, you're not alone. It's kind of a tech company that's dressed as an oil worker for Halloween. And maybe the market's just needs to take off the mask and see the real value here. And that's what I'm sort of attempting to do here with this sort of breakdown. Alrighty, financial highlights. Obviously, the key things when we're looking at a company, profitable company from a fundamental point of view. Let's see if McCoy puts the profit in profitable. Over the past 3 years, revenue has surged from nearly 33 million in 2021 to almost 70 million in 2023, a growth rate that even our favorite tech roll-ups would be proud of. Gross profit margins have also grown. They've been climbing. They reached almost 33% in 2023, up from about 28% in 2021. McCoy is squeezing more out of every dollar, and that's something that obviously every investor like you and me likes to hear. All right, slide 6, some continued financial highlights. Positive EBITDA growth in 2023. They hit 10.68 million, showing the company isn't just talking the talk, they're walking the walk. So if you're tired about hearing about those startups that are pre-profit, This might be a refreshing change for you. Now, next slide, let's talk about sort of net income. Their net income performance over the past few years, has been quite impressive. In 2019, they posted a modest net income of about 233,000. In 2020, obviously due to issues, supply chain, things like that, they actually had a loss of almost 2.2. But things had a sharp turn in 2021. They got up to just over 4 million in net income, followed by almost 9 million in 2022. But a decent chunk of that was from a non-reoccurring sale of a leaseback property in Texas. So if you strip that out, then 2023 would actually be a pretty good growth year, as they recorded just over 6.5 million in net income. While there's some fluctuation, McCoy has been consistently profitable since 2020. Okay, some of these other slides here, just some tables that kind of reflect some of the data in a different sort of visual way. I'm going to have a link to below in the description so you can view these slides on your own. Alrighty. Q1 and Q2 2024, how is the trend sort of being this year? In the first half of the year, revenue hit in Q1 16.5 million. Q2 it hit almost 20 million. Gross margins also kept climbing. Q2 they exited with almost 34% gross margin, and EBITDA in Q2 also jumped just over 4.6 million, with a net income of 3.13 million. Sure, they might have had a dip in free cash flow, but hey, even the best of us have some off days. And in McCoy's case, it's more of just an off quarter in terms of that. As long as they keep revenues growing, margins improving, I think there's a lot of upside here. For those of you that want to understand how you can have a positive EBITDA and negative free cash flow, here's a little bit of stuff you can read up on your own about how these two things are not connected, really, at all. Some valuation overview here. We should certainly talk valuation, the all-important measure that determines whether a stock is a diamond in the rough or just rough. Well, McCoy's price to earnings ratio sits at 9.2. It's EV to EBITDA ratios just under 5.4. And if you're looking for an undervalued opportunity in a company with tech-like growth, but more like service industry pricing of its shares, McCoy might be one to watch. I think the market's just starting to catch on to this rare find. The shares are actually up about 50% or so the last couple of months. And PE ratio for the industry that they're actually in is about 17. And the average EV to EBITDA is 8. Next slide, debt management. Well, some companies have debt, some companies love it, and then there's McCoy, which decided that debt's not their thing. They actually fully paid off their long-term debt as of Q2 2023. Now they're keeping things manageable with lease liabilities. It's a good look when you can say, as a company, that you're debt-free, especially a company that's in the products, space where they're having to reinvest into R&D and they have production facilities and whatnot. All right, cap structure, the all-important cap table. Let's sort of break it down. One of the things that's a real testament to McCoy is they've got less than 30 million shares outstanding, and they're listed on the TSX. Insiders hold about 7% of the company, so people running the show have some skin in the game. Always nice to see. I'd love to see that number increase a little bit, get it over 10. If we strip out institutions, they have about 28%. Showing some good long-term confidence from the last insider reports that I could see. While retail investors hold the rest, and we've started to see some healthier trading volumes. All right, capital return strategy. McCoy seems to be about giving back to shareholders. They've got a robust buyback program under their NCIB, targeting up to 10% of the public float. And they also reinstated a quarterly dividend of about 2 cents per share per quarter. So on a quarterly basis, a payout of about 540,000. Who doesn't like a little extra cash for holding on to a stock that's going somewhere? All right, 18. We can't just talk about all the good things. We got to talk about some of the key risks to consider. It's not all smooth sailing. There's some free cash flow volatility. something that we should keep an eye on, as are market cycles. When you're in oil and gas, even though you might not be a services company, you still have to sell to a services company, and things can be pretty cyclical. We've also got some elevated geopolitical risks. The competitive landscape is pretty dynamic as well. Staying ahead of it isn't easy. They have to reinvest into that. But with a 110-year history and a CEO that's been in place for over 20 years, assessing and navigating risks is obviously nothing new to this company. What's the investment thesis here? Why should McCoy Global be on your radar? Well, they got solid market position, track record of consistent, impressive financials. They're innovation driven, which keeps them ahead of the curve, with the management team that knows the industry like the back of their hand. And they've focused on maintaining very low debt levels. So they check a lot of the right boxes for me. If we throw in a strong cap table and a buyback program that targets up to 10% of the public float, and you've got a company that seems to know how to create shareholder value. I think they're a good takeout target as well, and could make a nice tuck-in acquisition for a larger US listed player or a private equity investor that's really looking to optimize the profits and the cash flow without the costs of being public, which are fairly significant these days. Anyways, that's really about it for today. Thanks for watching, everybody. It's my first, so I'm probably a little rusty, but I hope you enjoyed the deep dive here into McCoy Global. Trades on the TSX with the ticker MCB. If you have any questions, thoughts, or any feedback or suggestions for me, please feel free to drop them below in the comments below. And don't forget to hit the like and subscribe button and hit the notifications bell so you don't miss our next deep dive and next episode. Until then, happy investing, and I'll catch up with you in the next episode of Talk Stocks. Peace.